Two stocks in the S&P 500 have 100% buy recommendations by analysts, and the average price target for one of these is 49% higher. Just as important though, I found the 10 stocks analysts say you should sell right now. In this video, I'll show you the stocks to buy for 2022 according to the average analyst on Wall Street. I'll share data on which sectors analysts love and which not so much. I'll reveal the top 10 stocks to buy and the ones you should avoid at all costs. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and you know I gotta send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, it is a new year and that means new analyst recommendations for the stocks to buy in 2022. FactSet surveyed 10,785 ratings on stocks in the S&P 500 to find the stocks most loved and hated by analysts. Now, not surprising was the fact that more than half of those, 57% of those ratings, were for buy recommendations, while 37% were for hold, and only 6%, just 6 out of 100 recommendations, are to sell a stock. Now, what was surprising are which stocks analysts are recommending you buy and the return to the average price target. If you want to see more of the stocks I'm buying, I'm revealing the top 5 stocks in my own portfolio in a free report. These are the 5 biggest stock positions I'm holding, stocks to benefit from the biggest trends over the next decade. Make sure you check that out with the link I'll leave in the description below. Let's start with the stock sectors though. What groups of stocks analysts think you should buy in 2022? Now we see in green here the percentage of buy recommendations for stocks in each sector, along with holds in yellow and sell recommendations in red. On the far left, the most recommended sector is energy, with 67% of recommendations to buy those stocks and just 2% to sell. Energy stocks were some of the best performing in the market last year, and even though we probably won't see oil prices run much higher than $70 or $80 a barrel where they are right now, companies like Shell and Chevron are booking massive cash flow, and I think this could be one of the best sectors for dividends in 2022. Next most recommended are stocks in the communication services sector, so your internet companies and telecom stocks, with 62% of the ratings a buy and just 5% for sell. Now here I think the analysts are quite a bit more bullish on the internet names like Google and Facebook, but I would also look at those telecom stocks as well. Stocks like AT&T and Verizon have been crushed over the last year because they had to spend tens of billions of dollars paying for that 5G spectrum, but I think that's about to change soon. They're not going to have those expenses in this next year and will start booking the revenue on 5G, and that's going to mean higher earnings and cash flow. Stocks in the healthcare and technology sectors are also both strong favorites, with 62% of the ratings to buy. At the other end of the chart, though, we see the most unloved sector, consumer staples, with just 43% of the ratings to buy and 10% to sell stocks in that group. And companies in food processing, personal products, and those other things that you need to buy just have been hit hard over the past year on higher costs and haven't been able to pass those costs on to consumers, so profits have taken a dive. It's a similar story for stocks in the utility sector, with just 50% of the analyst ratings to buy and 8% to sell. Utility companies get their rate increases approved every few years, so that sudden run in inflation can hit profits for a while, and then even more if the approved increases aren't enough. All you out there in the nation know I love this kind of top-down investing, starting with the bigger picture in what sectors should do well and then using that to narrow your list down to stocks to buy. And here, we're looking for those big picture forces like interest rates, consumer spending, and inflation to understand which parts of the economy are going to do better in 2022. By starting with this, you're going to make investing so much easier, and you'll book higher returns as well. It's a hell of a lot easier to pick the best stocks out of maybe 100 in a sector than it is to start with the 5,000 traded in the market. You'll also know that even if you don't pick the very best stock in that sector, the best stock to buy, you're still going to do well because all the stocks in that sector will have those big picture forces behind them. Now I'm going to show you those top 10 stocks to buy next, but I also wanted to share this chart on how analyst recommendations have changed over the last year. These solid green bars here are the current percentage of buy ratings in each sector, while the striped bars are those from a year ago. And you can see here, analysts are getting more bullish in all but 2 of these sectors. Analysts are saying buy more in the stocks in every sector except utilities and consumer staples. And analysts have gotten even more bullish on a few of these. The percentage of total buy recommendations went from 53% last year to 57% currently, and no doubt on the hopes that consumers are finally going to get out to spend in 2022. A really interesting one, real estate. And this one is interesting because even though it's the 4th least recommended sector, The percentage of buy ratings has increased from 47% last year to 54% now. So Wall Street is more positive on stocks for 2022, but which are the top stocks it thinks you should buy? Here's that list, and I'll show you the percentage return expected in each of these, but look at these top 10 stocks. 2 stocks have unanimous buy ratings from analysts, and at least 9 in 10 analysts recommending the rest. Highlighting a few of these here, Alexandria Real Estate, ticker ARE, had a strong performance last year, rebounding from that steep sell-off in office space, and analysts expect it to keep on going. Now, one thing I want to point out though is look at this 1-year target estimate. Now that's the average price target from analysts, and for Alexandria, it's only about 2.7% higher than the current price. Now it is still a vote of confidence to have a unanimous opinion on the shares, but don't confuse these buy ratings with a guarantee of higher return. Specialty insurer Assurance, ticker AIZ, has more upside to the average price target with a potential return of 25% on top of that 1.8% dividend yield on these shares. And shares of Amazon here, ticker AMZN, have been flat since July after a huge run last year, but analysts still see the stock running 23% higher over the next year, and 96% of ratings are for buy recommendations. Now here I've added the upside potential to that average analyst price target for each stock, and check out Caesars Entertainment, ticker CZR. It's got a 47% expected return on it, no doubt on just a return to casino stocks, especially to the China market. Alaska Air, ticker ALK, is another stock with high analyst expectations for nearly 49% return to that average price target. Our shares are down 30% from the high last April, and analysts are hoping for some sense of normalcy in air travel. And next, I'm going to reveal those 10 stocks analysts think will lose your money, but I also need to warn you about these recommendations. First of all, you notice that those analysts are far more likely to hand out buy ratings than a sell or even a hold. In that survey of more than 10,000 stock ratings, only 6% or about 650 were to sell a stock versus 6,000 recommendations to buy. And analyst recommendations are always skewed like this. In fact, most analysts will stop talking about a stock rather than give it a sell recommendation. Now, part of this is because, well, you get in less trouble if you're bullish and wrong on a stock than the other way around. But more importantly, even though brokers and these analysts are supposed to be independent, they still catch hell from the banks they work for if they give those sell recommendations. You see, analysts working for the big banks like JP Morgan or Goldman Sachs, they help the brokerage side of the business make money on commissions, but far more money is made at the investment banking side, helping companies issue bonds and shares. A bank with analysts that are constantly bad-mouthing a company, they're not going to see much of that company's bond business. So yeah, analysts just have a tendency not to go negative. And the second warning here is that analysts just aren't perfect in their recommendations. Now, most analysts do a lot of work and do have the experience to estimate those profits and stock returns, but I know a few analysts that couldn't predict the weather if they were standing outside. But it is helpful to look at recommendations when you're deciding which stocks to buy, whether to give you ideas or just confirmation on your own research. And sometimes the most telling are the lowest rated stocks because analysts really need a reason to go negative on a stock. Here you see the 10 stocks in the S&P 500 with the highest percentage of sell recommendations. Here, not a single analyst recommends buying shares of Consolidated Edison, ticker ED, and 2 in 3 recommend actually selling the stock. The average target price is 12.6% lower from the current price, though the shares do pay a 3.6% dividend yield. Now, some of this weakness is just from that broader sentiment against the utilities sector that we saw earlier. Lumen Technologies, ticker LUMN, a telecom company under the CenturyLink brand, and this one has been a one-way ride lower since 2014, along with a lot of the other telecom stocks. The shares pay a 7.9% dividend yield, but analysts think there's still another 10% downside in the price to that average analyst target. Now, I think this is a similar story to AT&T, which I recently went bullish on and bought the shares. Besides being stable cash flow companies, I think the sales and earnings are bottoming for a lot of these telecom stocks, and valuations are really attractive. And sometimes, the best time to buy a stock is when everyone else says to sell. Clorox, ticker CLX, had a miserable year, down 17% in 2021, and analysts think it's still got another 6.3% lower to go to that average target. Besides some management missteps, this is also that broader negative sentiment against the consumer staples companies. Now, just like that top 10, I've added the percentage return to the average analyst price target for each of these. And you see most of these price targets are lower than the current price, so a negative return, though there are a couple here that while analysts are mostly negative on the stock, they still have a positive return to the average target. Now, some of these are just coming off really strong runs last year or the year before, so maybe have just outrun those analyst targets. Here, it's hard to say anything bad about Brown-Forman because it makes my Jack Daniel's honey liquor, so yeah, right there. Now, it's also interesting here that American Airlines, ticker AAL, is so unloved, while Alaska Airlines is widely recommended. Just 1 in 4 analysts recommend buying shares of American, while a third recommends selling the stock. Now, American does have about the highest debt burden in the industry, so unless airlines do really well this year, it could face problems on that. Click on the video to the right for the 11 cheapest stocks in the market, the cheapest stocks to buy for 2022 in each sector. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.